Aditya, what's your call for tomorrow? What's the Fed trade?
So I'd agree with Michael. Tomorrow is all but a done deal, 75 basis point hike. The focus in the November meeting is really on December. How much does the Fed lean into a downshift to a 50 basis point hike rather than 75? Markets are, pricing smack in the middle around 60, 61 basis points for December. So they're hedging their bets. And as Michael said, I think the Fed is going to stick with its data dependence mantra because there's two jobs reports and two CPI prints. So a lot of new information between the November and December jobs reports.
Aditya, if they're data dependent, why should they commit to the downshift? Why is everybody convinced that we're going to hear about the downshift if they are data dependent? Because as you say, we've got two CPI prints, got two unemployment prints, two payroll prints. We've got a lot of data between now and December. So why should the Fed commit to anything tomorrow?
Oh, I don't think they should or they will. I think it's more a matter of conveying to markets that this is an active discussion, that they are actively thinking about it. As the level of rates goes higher, you're going to hear more concerns, particularly from the doves of the committee, like Governor Brainerd and San Francisco Fed President Daley, about the sacrifice ratio, which is the amount of economic pain the Fed is willing to take on to bring inflation down back to target.
If we do get a downshift, though, does that necessarily mean it's dovish? So the RBA, everyone says, oh, that was the first central bank that downshifted, and that was necessarily dovish. But as we heard today, they're still hiking. It might be only 25 basis points, but it's close, and they're still going to do it. They're nowhere near done.
Right. So the challenge for Chair Powell will be if he wants to communicate a downshift. And again, I don't think he's going to do that explicitly. But if he wants to hint towards that, the challenge will be to remind markets that this does not mean a lower terminal rate. It does not mean earlier cuts. As we've been saying, it's about the destination, not the journey. So the key variable is the terminal rate, not necessarily how quickly we get there.
Aditya, can I just throw a slight curveball in? One of the reasons why the global economy has been able to see commodity prices coming lower is because the Chinese economy has not reopened yet. There were all kinds of rumors floating around a little earlier on today that that process may be about to begin. Were it to start to begin and China starts sucking in lots of natural gas, lots of energy more broadly, lots of stuff, copper, etc., how does that change the calculus for the rest of the world once that process gets underway?
Well, assuming that means commodity price inflation, which it probably will, then that's going to put pressure on the Fed to do more. So the risk scenario here is, you combine that potential reopening with China with, continued strength in the labor market. Labor market isn't really slowing down as quickly as the Fed might have hoped. We saw that in today's JOLTS report. You put those two factors together, you get higher wage inflation, higher price inflation, and Powell has said that the Fed ultimately cares about headline inflation, not core, because that's what people experience on a day-to-day basis. So the Fed's probably going to have to do more in that scenario. And, so the risk is for a terminal rate, more like 5.5%, even if that's not our base case.
And then the other wild card, too, is active quantitative tightening. So the roll-off is one thing. The BOE is the first central bank to actually start actively selling in the market today. We're going to get those results really in just a few minutes. Do we know yet what the impact of that is truly going to be in terms of tightening financial conditions and the financial stability element, which I appreciate isn't a mandate, but nonetheless is going to be a huge wild card for central banks?
I don't think that's really on the table for the Fed. They're quite happy with the way they're doing QT, which is in a very passive manner. And I don't think there's any impulse for them to really change their approach to QT, regardless of what the Bank of England is doing.
Aditya, let's talk about ultimately where the risk is to the upside or the downside on your call for where the Fed ultimately ends up. What is your sense right now of where that risk lies? Upside or downside?
Upside. Based on what I said, the labor market could take longer to slow down. We could take longer to go into a recession. Those two are obviously very closely related, and inflation could remain sticky high. One thing we pointed out recently was that if you look at the last 19 months, the CPI has missed to the upside of consensus 12 times and to the downside just twice. The cumulative miss has been 2.5 percentage points in 19 months. So certainly the risks are that inflation will remain sticky high, which means more Fed hikes and higher rates, delayed recession, but potentially a deeper recession as and when it happens.